our base case is tracking. We still think we're going to make a good move towards 7,300 for the S&P 500. And today we did raise software, which is also the ETF IGV, to beat a top pick sector alongside Mag 7 and crypto.
In this video, we're breaking down what Tom Lee is seeing right now, why this rally might be built on real fundamentals, how AI is quietly boosting the entire economy, and whether this market could go even higher. If you enjoy content like this, breaking down markets, macro, and where things are headed, make sure to like and subscribe. It really helps the channel grow and reach more people.
Percent. Tom, we're clocking 28% earnings growth.
Yeah.
That's remarkable. That's why the market's been looking outside of the oil complex and away from the war and any of the other, rising rates from time to time. The market is just not having it because it's busy feasting on these earnings.
That's right, Scott. In some ways, it's showing you that revenue growth, which has been better, is delivering each dollar of upside to revenue is delivering a lot of earnings growth. So there is a margin story at work, which people would say is productivity, but it shows you the return on investment for the U.S. economy is also going up, meaning I do think that this is an example of AI actually having positive payoffs for the economy and for earnings.
This is where things get really interesting. He's basically saying AI isn't just hype anymore, it's actually increasing productivity. And that shows up in higher margins, better returns on investment, stronger earnings per dollar of revenue. This is the exact kind of thing that can sustain a long-term bull market.
For example, 1 month, okay? In 1 month, the Nasdaq's up 15%. You've had a bit of narrower breadth in the market, to which Goldman's Ben Snyder today says sharply narrowing breadth has historically indicated equity market drawdown risk. S&P's up 14% from the low in March. The median S&P constituent, however, remains 13% below its respective high. How do you reconcile that?
I think that I'm going to look at this as a series of rolling bear markets, because we know the Mag 7 and the software stocks peaked a lot earlier than the broader market did. And then they led into the low, but then bottomed first and are rallying. So I think that we should expect breadth to follow, but it would be pretty textbook because, tech is what peaked earlier, several months earlier before the index level market actually peaked.
His response is actually pretty nuanced. He's saying this isn't one big synchronized market move. Instead, different sectors peak at different times, bottom at different times, recover at different times. And right now, tech is just ahead of the curve. If he's right, the rest of the market could catch up next.
Well, I know strong markets tend to, and I'm going to sound not very original, but strong markets stay strong. So I think the strength that we've seen is a good sign. And we also know when we look at the data that institutional investors caught the bottom. But I think in 2026, it's retail that kind of missed the low, but they have a lot of firepower. So I think it's going to be a retail-driven buying of stocks. And that's why I think broadening can take place, because as you know, retail investors do like small and mid-cap stocks as well.
This is one of those simple but powerful ideas. A lot of people think the market went up too fast, it has to come down. But historically, strong momentum often leads to more strength. And that's the case he's making here. So here's the big picture. Earnings are massively beating expectations. AI is starting to boost real productivity. And the rally, according to Tom Lee, is actually built on solid fundamentals, but market concentration is still a real risk and not every stock is participating yet. So the question becomes, is this the early stage of a bigger move, or are we closer to the top than people think? Let me know what you think in the comments.